Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 29th of September 2021. And we were not planning on doing another video today, as this will be our third. However, having seen silver crash to $21.50, and actually dipping even below that, we simply had to let you know what is going on. But firstly, a quick shout out to the two videos we produced earlier today: Why Buy and Own Gold, an interesting perspective, and our Wednesday morning gold and silver update and forecast, where we actually saw first thing both gold and silver creep up ever so slightly. And we've placed links to both of these below. But perhaps more pertinent was the video we produced yesterday. Beware of gold and silver pumpers and clickbaiters. And again, we've placed a link to that one below. Well, we warned everyone about the pumpers and how they've been claiming that silver is about to go parabolic. Well, if after today you still believe these charlatans, then frankly, there is no hope for you. So let's take a look at what actually happened to silver. Okay, so let's paint a background image first. Yesterday, Fed Chair Jerome Powell testified before the US Senate Banking Committee. In his prepared remarks, he said, quote, "Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors. These effects have been larger and longer lasting than anticipated, but they will abate, and as they do, inflation is expected to drop back toward our longer run 2% goal." Unquote. Now, Przemysław Radomski pointed out on FX Empire that Powell has changed his wording concerning inflation from transitory to moderating, or certainly their policies relating to it. Now, on Monday, New York Fed President John Williams told the Economic Club of New York, quote, "I think it's clear that we have made substantial further progress on achieving our inflation goal. There has also been very good progress towards maximum employment. Assuming the economy continues to improve as I anticipate, a moderation in the pace of asset purchases may soon be warranted." Unquote. Now, Fed Governor Lael Brainard added that labor market conditions may soon warrant a reduction in the Fed's bond buying program. This is what he said, quote, "The forward guidance on maximum employment and average inflation sets a much higher bar for the liftoff of the policy rate than for slowing the pace of asset purchases." Now, this is what he told the National Association for Business Economics. "I would emphasize that no signal about the timing of liftoff should be taken from any decision to announce a slowing of asset purchases." Unquote. And then to cap it all, on Monday, Chicago Fed President Charles Evans also told the National Association for Business Economics, "I see the economy as being close to meeting the substantial further progress standard we laid out last December. If the flow of employment improvements continues, it seems likely that those conditions will be met soon and tapering can commence." So, although Fed Chair Jerome Powell has tended to be seen as the most dovish, or one of the most dovish of the Fed governors, we can see that today, or yesterday, he became quite hawkish, and this is backed up by the other Fed presidents. So this is important, as they are clearly setting the scene for early tapering of their bond buying, which some believe will then pave the way for higher interest rates to follow sooner rather than later in 2023, so that perhaps we could see interest rates rise as early as mid-2022. Of course, we've already heard in the United Kingdom about the prospect of interest rate rises early in 2022 here. Now, on the back of this, Radomski points out, quote, "The US 10-year Treasury yield has risen by 19% over the last 5 trading days. What's more, the US 5-year Treasury yield has risen by 24% over the last 7 trading days and ended the September 28th session at a new 2021 high. For context, the last time the US 5-year Treasury yield closed above 1% was February the 27th, 2020. Now, we have to bear in mind that it's all very well us waiting for the Fed or the Bank of England or the European Central Bank to decide whether they're going to raise rates or not. But the market can, to some degree, do it for them automatically. Now, with the Fed moving towards a hawkish path, we can see that the ECB is heading in the opposite direction. For example, European Central Bank President Christine Lagarde said yesterday that there are, quote, "no signs that this increase in Eurozone inflation is becoming broad-based. The key challenge is to ensure that we do not overreact to transitory supply shocks that have no bearing on the medium term. Monetary policy should normally look through temporary supply-driven inflation so long as inflation expectations remain anchored," unquote. Well, of course, this has served to strengthen the US dollar even further. And many analysts now believe it may continue to rise for some time to come, because if the ECB does not adopt more stringent measures, then we will see an absolute flood of monies moving from other currencies directly into the dollar, thereby increasing the value of the dollar even further. So we have precious metals caught in the crossfire between rising bond yields and a strengthening dollar. With all equity markets also under suspicion, this may continue to play against the price of gold and silver moving forward, as we have explained time and time again. Now, this morning and last week we mentioned that we would expect to see the US dollar index reach 94. If you recall, it was in the early 92s. And we could see it go even beyond this level. And this afternoon, it has done just that. At the time of writing, it stands at 94.35. That's up 0.58 on the day. It was below 93 when we produced our video this morning. So, we currently have silver down 95 cents over the last 24 hours, and it's standing at $21.50 as we produce this video, a fall of 4.36%. And gold is down $11.30 at $1,724, a fall of 0.65%. Now, we have frequently warned that silver will be hardest hit as the economy slows rather than improves, and the industrial demand for silver therefore is affected. Of course, if the economy was far more robust and rapidly growing, then the opposite would occur. So ignore the nonsense from the likes of Keith Neumeyer and his pumper colleagues, whom we proved wrong yesterday when he pointed out there's not enough silver in the world to meet demand, and we showed you what the Silver Institute produced. There is a surplus amount of silver supply compared to demand, and they represent the industry. And for those who now will call the markets manipulated by governments, they are pushing the price of silver down. Well, just try and explain the logic here then. If Keith Neumeyer is right and there simply is not enough silver to go around, then why the heck would governments push the price down, thereby enticing people like us to buy more? It makes no sense. So, where are we going from here? Well, there might be a slight pushback recovery with silver perhaps regaining a tiny bit of ground, but we are seeing that some analysts are now predicting $20 silver, particularly should silver close the week below $22. And some are even calling for $19 silver. But most agree it's unlikely to hold there for long. But of course, again, we believe it's dictated by the strength of the US dollar. Now, when we produce our update tomorrow morning, we'll have more to say, as we will have seen more reports and gained a better picture as to what is happening. But meanwhile, we'll just show you on screen what Bloomberg has just reported, and at which point we will end the video. Therefore, please do give us a thumbs up if you like it, give us a thumbs down if you don't, subscribe and press the bell sign. So let's now move over to Bloomberg, and thank you for listening. Bloomberg article dated September 29th at 4:09 p.m. GMT+1. Silver extends drop to lowest in a year as dollar keeps rising. Silver extended declines to the lowest in more than a year as the dollar advanced. Gold gave up early gains. A gauge of the dollar touched a fresh 10-month high, reducing the appeal of precious metals for foreign currency investors. The greenback has remained strong since the Federal Reserve signaled last week that a reduction in stimulus could happen soon, which drove up Treasury yields. Quote, "We continue to expect silver to underperform gold on a risk-adjusted basis, as a normalization in industrial demand further weighs on the white metal, while flow effects from tapering QE should also weigh on silver," unquote, TD Securities analysts led by Bart Melek said in a note. Spot silver fell as much as 4.6% to $21.42 an ounce, the lowest intraday level since July 2020. The white metal is headed for its biggest monthly loss in a year, while gold is on course for its biggest monthly decline since June. Both precious metals are under pressure this year as more central banks start signaling a pullback in stimulus measures used to cushion the economic impact of the pandemic. End of article. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.